We're going to talk about what causes Social Security to be taxed. What is combined or provisional income? They used to call it. Now they're calling it combined income more. Social Security thresholds that you need to be aware of that cause the taxation. How much does it really cost? And then how can we reduce or eliminate that taxation? So combined income is an income that the IRS tracks, and it's based on certain factors of your income. It's not what you think of as taxable income or revenue coming in. It's not from a paycheck or a pension, that sort of thing. However, the IRS tracks that, and they use that to determine whether or not your Social Security will be taxed or not. Now, what counts as combined income? Well, there's a list, of course, and you may not like it. I'm just going to put it up here, and then we'll go over them one by one. So we're talking about all of your earned income. So if you do any work and you get a W-2 or 1099 from work, then that counts. Distributions from your IRAs, your 401ks, whether you're pulling out of there or you're taking requirement of distributions and you have to, all of those count. They go on the list. And then 1099s. If you have a high interest or high yield savings account, and you're making 4% a year on whatever you got in there, that 4% is going to be on this list and taxable, by the way. You're going to get a 1099, we call it a love letter from the financial institution. They send that to the IRS as well, so they know about it, so you can't hide that. Pensions, like we spoke about. Some rental income, so if you have an LLC and then you get income through that, then that'll go on this list. Interest from municipal bonds. Municipal bonds, people like to think they're fully untaxable, but they're actually not, because they can trigger Social Security taxation. And depending on the type of bond, you can also have capital gains tax. We'll get more into that later on when we talk about tax deferred accounts. Now, this one I say is my personal favorite when I'm discussing this with people, but I'm actually being extremely facetious, because to start with half of your Social Security income, to determine how much of your Social Security income is going to be taxed, doesn't seem to serve people very well. Not the people drawing the Social Security anyway. So, and that's my soapbox for the day, and we'll get off of that. So, the combined income thresholds that will determine Social Security taxation are, for a joint filer, under $32,000. None of your Social Security gets taxed. 32 to 44,000 up to 50% gets taxed, and then above 44,000 up to 85% gets taxed. What does that mean? Well, say for example you're between 32 and 44,000, then up to 50% of your Social Security income will get taxed at your highest marginal tax bracket. That doesn't mean that you'll pay half of your Social Security in tax. It just means that it gets taxed at whatever tax bracket you find yourself in as a result of that. Now, one of the things you want to look at is on the Form 1040, where you file your taxes, and most people never look at this because they're afraid of it. But you want to look down around, I think it's around line 19 or 20. This is where the provisional income gets listed. and on that, the next line is what part of that Social Security that you make will be taxed. Now that actually gets added on to your modified adjusted gross income, which may sound like complete Greek to a lot of you. But basically that taxable portion of your Social Security income, if it is taxable, becomes part of your taxable income, which could push you up into a higher tax bracket. Now remember, we spoke about that when we talked about the myth of retirement, where you're going to be in a lower tax bracket. That's not necessarily the case, and this is part of the reason why often. So we need to do what we can to help you avoid this. And again, if you're working with another advisor, great. Talk to your other advisor about how you do this. Some of them will and some of them won't, because it's a tax subject and they don't like to address that, and that's fine. You can find accountants. We'll be happy to talk to you and just give you guidance. It's fine. Okay, now if you're a single filer, the thresholds are under 25,000, 0%. 25 to 34,000 is up to 50%. Then above 34,000, it's up to 85% of your Social Security income that gets taxed at your highest marginal tax rate. Remember that. Now, excuse me, here's an example. we have Jack and Jill, and this is their income, pension $36,000 a year, and this is based on a real life couple that we actually work with. And well, I don't want to spoil anything, but we're actually helping them quite a bit, and they may get out of. They're already getting out of a lot of the taxation. So here we go. So the pension is $36,000 a year. The requirement distributions would be $195,000 a year because they ended up stuffing their 401ks like they were told. And they've got a fair bit of money. Actually, they've got quite a bit of money, which is good, but it's not in the right bucket for tax optimization. We'll say it that way. So, and they're going to get $60,000 a year in Social Security. So half of that would be $30,000. Now, their total combined income per the IRS tracking list is $261,000, causes 85% of their Social Security to be taxed at their highest marginal tax rate, which is 24%. Now, their total Social Security is $60,000 a year at 24%. At $60,000 a year, 85% of that becomes taxable. It's $51,000 at 24%. Equals $12,240. Now, that's the initial impact. This is where it starts. And this is, as we move through this, even if this isn't bad enough, just wait, there's more. Now, they have to compensate for this tax. And as I said before, when people start to file their Social Security or their tax return after their first Social Security checks start to come in, this is where they make this realization. So these guys are going to be taxed an extra $12,000 plus that they were not expecting. If you have all of your funds in tax deferred accounts, such as your 401ks, then a lot of people will take the money out of those tax deferred accounts to pay this tax bill. And what happens when you do that? Well, you get taxed on it because all the money that comes out of there has to be taxed. So essentially, they're paying this tax bill with taxable money. And at 24%, this adds on an extra just about $4,000. So this tax bill now becomes $16,000. But wait, there's more. This is also an interesting fact. There have been many studies that show that if you have your Social Security taxed, especially if it's a surprise, then you tend to run out of money 5 to 7 years sooner than the average, than if you don't. So if your life expectancy is 84, then you get to die. You got to die around 77, 79 instead, and nobody wants to plan for that. So don't do that. Social Security taxation. It also causes you to take the other assets that you've built up and sell those off, whether you want to or not, whether it's at a profit or not, because you need the money if you don't have it somewhere else. Now, what are they really losing here? Some of you are already familiar with the term opportunity cost, and the nutshell version of that is what could you have done with what you had to do with something else, or to cover something else, right? So these guys, they've got to spend $12,200 in taxes, and if they pull it out of their tax deferred accounts, they're pulling out $3,900, so $16,000. But it's not just that. It's what could this $16,000 have done for them in every year that they have to do this. So if they do that for 20 years, and they could have made 8%, then what they're really losing from that is, any guesses? Any guesses? Anyone in the audience? Okay, well, here you go. About $790,000 bucks. So there's another $800,000 they're leaving on the table or spending. So they may end up selling something else or some other things to do that. Maybe, maybe not. But the point is that this is unnecessary, and this could be their $800,000 and not the IRS's. Now, there's always somebody in the audience who says, well, what if I have the money in my checking account? I can just pay that extra tax bill. And some people do, and that's great if you do. But if you could have avoided the tax bill in the first place, and then you don't have to write them a check at all, that's even better. So the opportunity cost for that, if it just comes out of your checking account, is about $600,000, which could also be theirs instead of the IRS's. So in case you're wondering, the purpose of us being here is for you to keep your money and not give it to your business partner, the IRS. Right? Did everybody in here know they have a business partner? Yes. The IRS is your business partner if you're born in the U.S., whether you like it or not. So now, here, but wait, there's more. If leaving $790,000 on the table doesn't seem bad enough, and it is, or even $590,000, there are a couple of elements to consider here. Those thresholds for combined income, they haven't changed in years, but Social Security goes up every year because it's indexed for inflation. So remember, half of your combined income is Social Security income, and that's adjusting every single year, going up. But the threshold is not. So more people meet that threshold every year just because that Social Security income is going up. Obviously, this is worth preventing. That's the punchline, yes. And your tax bill is likely to be higher the next year. And then if you end up pulling that out of your tax deferred accounts again, then you're going to end up spending more in taxes and losing more due to opportunity cost. As if the inflation right now isn't bad enough, right? Okay, now let's talk about IRMA for a second. We're going to talk about a few phantom taxes that get added onto because of Social Security if your income is high enough. I'm not going to spend a whole lot of time on them, and I want you to research them on your own. We have a website that you can go to as a source. It's not ours, but you can always go to our website too. IRMA, Income-Related Monthly Adjustment Amount. It's a surcharge on your Medicare. Now, a lot of people don't know this, but your Medicare premiums actually get paid out of your Social Security income. And this is also another surprise to some people when they get there. IRMA is a surcharge that they add on to these Medicare premiums if your modified adjusted gross income is over a certain level, right? So if you're a single filer, the first surcharge is at $103,000 this year, and if you're joint filers, it's $206,000, and they look back 2 years, which doesn't seem fair, but that's how they do it. So when you're coming into Social Security and Medicare, and your income is that high because you're coming off of work, and this does happen to some people, they will still charge you this surcharge. Alternative minimum tax. Yeah, it's a tax that runs in tandem with the federal, and it has a top tax rate of 28%. And they use this for retired people who, high income earning retired people, we'll call it that. So whichever of these taxes is higher is going to be the one that you're charged. So again, you can do more research on this, and we'll be happy to talk to you more about how to avoid this. Remember, evasion is illegal, avoidance is encouraged. Net investment income tax, or NIT. This is a 3.8% tax on top of capital gains tax. So let's say you're selling stocks or rentals and that sort of thing. And it is also designed for retirees with higher incomes that are making capital gains and are making money from capital gains. As 3.8% tax on top of that, $200,000 if you're a single filer, $250,000 over $250,000 if you're a joint filer. Now, retirement distribution planning. These are actually better words because this is what allows us to help you get control of the situation. And for most people, we can. This is accumulating the right amount of assets in the right buckets. In other words, the right types of retirement accounts to make it so that when you are in retirement and or before, that two things are happening. You're paying the absolute minimum taxes to include Social Security, in other words, not paying or paying as little as possible. And two, if we can, to get somebody else to pay for it. We'll talk more about that. I know that almost sounds too good to be true, but you can actually get other sources to cover a lot of this tax bill for you. Now, the three types of investments. You have taxable, tax deferred, and tax preferred, or tax advantage, tax free. Some of you are aware of some of these, some of the accounts that go into this bucket already, but we're going to go into a little bit more detail here. Now, we've already sort of determined that tax rates are likely to go up in the future. There are many reasons for this, and if they go down, that's great. Then we'll take advantage of that too. If they stay the same, we'll take advantage of that too. But most likely, they will go up at some point in the future. Now, how do we, in a rising tax environment, help you protect your wealth and your income as you get into retirement from rising taxes? Well, that's what we're going to figure out here. Let's talk about the buckets. We're going to talk about the buckets and how to use them to maximize your tax flow. Everybody's favorite question. We get this all the time. Should I have a regular Roth or a regular IRA, or should I have a Roth IRA? And the answer is probably both, and it depends totally on your situation. And when should you convert? That's a big question too. And how do these affect your Social Security? Also a big question. Now, and then the big part is strategies. How do we reduce or eliminate these taxes? We'll get that done for you. Now, the taxable bucket. This is the bucket where you get that love letter, the 1099, from the institution where your funds are. So let's say you have a high yield savings account in a bank. You're making 4% interest. You're pretty proud of yourself, and that's great. Your money's just sitting there. You can see it every day, and you can see that it's making 4%. Now, if you have $100,000 in there and it's making 4%, you're going to have to pay taxes on $4,000 of that because you'll get this 1099, and so will the IRS. So they'll know you made that, and they will expect their cut, right? Now, the benefit, and these are types of taxable accounts. The benefit of these is, one of the main benefit is that it is there. You can see it. You can go to the bank and pull it out, typically without too much of a fuss. But that's changing a little bit also. The downside of these accounts is that as inflation goes up, you lose purchasing power, and they're taxable. So there are some better ways to manage this, but they make great emergency funds. Now, there's a better way to do an emergency fund, and we'll talk a little bit about that in a second. Now, in an emergency fund, it's advisable to have 3 to 6 months of living expenses. Wherever you fall on that, 3 months, some people are at 1 month, some people are at no months, some people have to have 6 or they can't sleep at night. Whatever works for you is great. Now, if you put it into a savings account, you're making 0.2 or whatever the bank pays now, up to 4 or 5% high yield savings account or a CD, that's fine. If you, another way to do that, and here's a little strategy tip for you, if you put that money into the money that you can into a Roth IRA, then you can use that as a savings account of sorts, because you can pull out everything that you put into a Roth IRA without penalties or taxes or anything, because you've already paid taxes on it. So that's one strategy that we'll talk about a little bit later on. And we use that all the time. So pop quiz, what's the ideal balance to have in a taxable bucket? 3 to 6 months living expenses, right? Okay, now the tax deferred bucket. These are your 401ks and your IRAs. You don't pay taxes on the way in, and all the money that comes out, including the gains, is taxable. Now, we're looking at 401ks, IRAs, 403bs, SEPs, some fixed index annuities, although you can defer taxes with a fixed index annuity, and that's a major upside. Okay, here's an example. So if you make $100,000 a year and you're over 50, you're able to contribute $8,000 of that into your traditional IRA, then your taxable income becomes $92,000 instead of $100,000. That's also a major benefit that you should take advantage of up to the point where it makes sense. Now, some of that depends on age, some of that depends on how much your employer's matching, if they are, and it depends on how much you're contributing. So the old idea of just stuff it in the 401k and just keep doing that not mathematically ideal. We'll say that. Now, when the money comes out, it becomes ordinary income, so it adds to your graduated cylinder of income and gets taxed at higher rates along the way as it builds up. Now, also keep in mind that wherever that ends up, and then your Social Security that gets taxed is on top of that, that's going to be where your Social Security gets taxed. So you're going to want to think about that. And usually, there are some exceptions, although not many. You have to be 59.5 before you pull money out of these accounts. Otherwise, you get penalized 10%, and you got to pay taxes on it because you have to pay taxes on it anyway. But you don't want to have to pay that extra 10% unless it's absolutely necessary, and there are other ways to mitigate that and plan so that you don't ever have to touch this money. Now, required minimum distributions, we've touched on that, call them RMDs for short. They have different ages that they start, but basically it goes something like this. If you have money in a tax-deferred account, the IRS has let you grow that tax-deferred the whole time. You've not been taxed on it the whole time. You've taken a tax deduction on the way in, which is great. And now it's time to pay the piper. So they want their money, and they will get it. So here's what happens. When RMDs become due, if you don't pull out the money that you should from there, they'll charge you a penalty, which is usually 50%. And there are some exceptions they've introduced, but they didn't. They didn't used to be so lenient on that. And you get taxed on it, of course, because you got to pull it out of a tax-deferred account. If I sound like a broken record on that, there's a reason for it. So these are according to the Secure Act, these are the changes that have been implemented. Required beginning date is the date that you absolutely have to pull out that certain amount from those tax-deferred accounts. Now, depending on your age and when you were born, and like I said, we're going to send you these slides, so I don't feel like I need to read to you, but if you fall in this category, then by April 1st the following year, you have to take your first one and then do another one by the end of that year so that you get caught up, all right? This chart is a little bit old, but it also is not my favorite chart, and I'll tell you why. Because this is what shows the percentage of your account you have to pull out as required minimum distribution once you start taking those. It starts at about 3.77%, and then it goes up to 16% at age 100. So every year, those tax-deferred accounts you have to draw more out of those. And assuming that you have growth in there, then that amount grows even more. Now remember, combined income with Social Security, if you have to pull more out of there, then that number goes up along with Social Security, which is also going up. So keep that in mind. And that is the end.